activity and making this seminar possible. And I thank also Narendra for his untiring efforts in making the presentation. You guys can see the presentation? All right.
No, not visible.
Okay.
Not visible.
Yeah, just give me a minute. I'm trying to share the screen. One second. I think you have to.
Harsha, you're on mute.
Yeah, I'm trying to share the screen, sir, but I think I have a problem. I'm asking Narendra to share the screen. Okay, I hope everyone can see the screen, the presentation.
Yes, it's visible.
Okay, okay. The whole idea of getting this particular presentation, non-disclosure of foreign assets and consequences in the Black Money Act, this entire idea has taken birth when we understood the Income Tax Department in AP and Telangana has issued close to 2,000 notices to various individuals, asking them why they have not disclosed their foreign assets in their income tax returns which were filed from last couple of years. So this entire activity or exercise is being conducted by Foreign Assets Investigation Unit, FAIU, which was constituted mainly to get the foreign income and assets which were being hoarded by individuals outside India. See, if you see the title of the act, the Black Money Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015. A normal resident individual like me and all the participants would think, how am I related to this Black Money Act? I earn money here, I pay tax here, and why should I get into this Black Money Act? The title of the act itself is sort of misleading, where it tries to focus only taxpayers who have concealed income from Indian tax authorities and started investing outside India in assets or income generating sources which were never disclosed to the income tax authorities. So the main objective
क्या कर रहा वही सोच रहा हूँ
Excuse me. Can I request you all to switch off your audios, please?
Shika,
वो तो है बट तू
you
देख
mute
रहे
everyone, no, except
pyramid technology
mute everyone.
है ना कौन से
Who is talking in between, please?
वो तो लगा रहा हूँ पक्का हेलो
Mute everyone.
Mute yourself, please. Sorry, sir.
Not a problem. So the entire, like I was saying, when we see the title of the act, the Black Money Act, we, as a normal resident individuals, we will never think that we will have implications in the Black Money Act. We are supposed to read this act. We will never think in that way because we were never concerned with black money. So all of us know what black money is. Black money is, we have seen in movies, we have seen in a number of series which are now coming. And we all understand what black money is. Like, just to put it in simple words, black money comes in two forms. One in a legitimate way, and one in another is illegitimate way. Illegitimate way is human trafficking, all drug usage, and everything, and all that is where you generate money, and that is never never comes into the tax eyes because it was never. Though you wanted to offer tax on it, no one is ready to take tax on it. The other is the legitimate activity where I generate income from a legitimate activity, but I'm still concealing it from the tax authorities and keeping it away from the eyes of the tax authorities. So both of these are the main sources for the black money act, black money. And this act basically concentrates on the foreign assets and foreign incomes, which are basically located outside India. That is the main ambit of the law. The black money law is always targeting at black money, which is generated in India and not subjected to tax in India, but is being used in creating assets or sources of income outside India. That is the main target of the black money, this particular black money act. There may be situations where black money is generated in India and that particular black money is being used in India for creation of assets or different sources of income. All these are under the ambit of the Domestic Income Tax Act, 1961. The Income Tax Act has specific section 68, 69, 69A, and all these sections, all that infrastructure is there to take care of situations where black money is generated in India and is being used to create assets or income sources in India. This particular act, which we are going to discuss, the Black Money Act, this focuses on black money generated in India, went to places outside India through illegal means, and thereby creating assets outside India, and thereby creating sources of income outside India. So the main target of this particular act is to consider those individuals or companies or firms or whatever type of assets where they have erstwhile generated black money and they have used them to create assets or sources of incomes outside India. This act has come up in 2015, though it is effective from 2016. There was a declaration scheme which was there. While the declaration scheme, the central government has asked all the people who want to declare their foreign assets and foreign incomes outside India and pay a tax and come with the clean hands. So this is the main objective of that particular Black Money Act. Today we are concerned in a different manner with this particular act. As I said in my opening remarks, though I'm a resident individual, I'm just a salaried employee. I'm working from morning to evening, earning salary for my family. But still, I am being subjected under the proceedings of PMA in a different way. We will see why I'm being asked now to come before income tax authorities, specifically FAIU, and why there are proceedings on me under BMA. So when we talk about BMA, this I'll be using it as BMA, Black Money Act. So there are certain aspects which we have to keep in mind. Who are covered? What is the type of assets which are covered? What is the type of income which are covered? What is the overlap between the Income Tax Act and the BMA Act? All these aspects should be in place to decide and determine whether I am being subjected under this particular act or not. Let's take a small example before we proceed further, because once we have an example in place, I think the provisions will come into better appreciation. I'm a salaried employee working for an Indian company. The Indian company is a subsidiary of a multinational company which is located outside India. By virtue of my employment with the Indian company, I was also granted ESOPs. Everyone is aware what an ESOP is, employee stock option plan. So I was given this option of ESOPs and I have subscribed for those ESOPs. Now the question is, the ESOPs were given with a foreign holding company. So I, by virtue of employment with an Indian company, got shares of a foreign company. So now the question which comes up here is whether I am I required to be falling under the BMA Act? Should I go to the BMA Act, Black Money Act, and should I see whether there are any compliances or obligations on me which I have to fulfill? So this is the case study which I want to take, which I will be using for next 15-20 minutes. And then we'll understand what is the impact on this particular resident individual who, by virtue of his employment, got some foreign shares of the holding company. So in order to understand this particular implications or impact on this particular resident individual, we should also understand what the Black Money Act entails, what it tries to cover. So when it comes to coverage, first we'll talk about who are the people covered under the BMA. So the persons covered is every resident individual is covered. So if you're a resident means in terms of Income Tax Act Section 6. So if you're a resident of the, if you're a resident, then this particular provisions of BMA will come into play. Here also we need to understand if you are also a resident and you bought some foreign asset, like say when I was resident in India, I purchased a house property in America. So after a few years of my residence in India, I moved to USA and there I became a resident. So I became a non-resident in India. So this particular act will also apply to residents who have acquired assets when they are resident and later on they became non-residents. So this particular act predominantly applies to residents and assets which were acquired when I was a resident and later on I became a non-resident. And what is this particular act covers? It covers two things, undisclosed income and undisclosed asset. First, we'll talk about undisclosed income and then later we will go to undisclosed asset. Undisclosed income, they say income from a source outside India, which is not disclosed in the income tax return. So I'm a resident individual. I have an income from a source outside India, which I've not disclosed in my income tax return. This falls under the ambit of undisclosed income. Continuing with our example, let's say the foreign company shares which I was holding by virtue of a ESOP plan got vested in me, and thereby I have complete rights on those particular shares. And now I started earning a bit dividend on those particular shares. That dividend, for whatever reason, maybe it's a meager amount, or maybe the tax was being withheld in the US markets, the US dividend payer, for whatever reasons I've not disclosed in my ITR. So the question which arises is whether this particular dividend income, which I was getting by virtue of holding some foreign shares and which I have not disclosed in income tax return, will it come under the undisclosed income? The answer would be right. Here, you have to consider that there is no requirement of satisfaction of mens rea. There is no requirement whether you are willfully not declared or intentionally not declared or genuinely not declared. As long as it's a non-declaration, that becomes an undisclosed income. The definition is in that way. So undisclosed income, as I said, income from a source outside India, which is not disclosed in the ITR, or I have not filed an income tax return. So as long as I'm not filing income tax return, maybe my maximum amount which is subject to tax is not exceeding here. That is the reason I'm not filing return. That reason you cannot take because there is a specific section under Income Tax Act which mandates you to file a return if you are holding a foreign asset. That is particular section. So even though your amount which is not subjected to tax here, not exceeding that threshold, still by virtue of this income, you should have filed an income tax return. So if you have not filed an ITR for a source of income which is outside India, or you have filed an ITR but you have not disclosed that particular income, that falls under the ambit of undisclosed income. So now let's go and see what undisclosed asset is. The definition goes like this: undisclosed asset located outside India means an asset located outside India held by the SSC in his name, or in respect of which he is a beneficial owner, and he has no explanation about the source of investment in such asset, or the explanation given by him is, in the opinion of the AO, unsatisfactory. So if you see undisclosed asset means it should be an asset located outside India. Like in our example, the shares of the foreign company which are located outside India. I have not, we have dealt with the dividend which is not disclosed and it becomes undisclosed income. Now comes the question of shares, whether the shares, if I have, should I disclose it or should I need not disclose it? If I don't disclose it, then will it be an undisclosed asset? Or if I disclose it, it stops being an undisclosed asset. So I think you're understanding the basic difference between undisclosed income and undisclosed asset. Undisclosed asset, they are not bothered about the disclosure. They are only penalty is there if you are not disclosing it. But as far as undisclosed asset is concerned, if you explain the source of investment for that asset and AO is happy with that explanation of that source, then it falls out of the ambit of undisclosed asset. So in the case study we have taken, I being a resident individual obtained shares of a foreign company. Here I can very well explain the source of investment for the acquisition of the foreign shares. That is nothing but my employment with Indian subsidiary, my 3 years or 4 years, the vesting conditions which I have put here. This qualifies as a source of investment. And this source, in majority of the cases, the AO will not dispute it. So here I'm able to explain the source of investment. Though the asset is located outside India, still it will be out of the definition of the undisclosed asset. But there is a separate penalty which is levied on me for not disclosing this particular asset in my returns. So there are two important concepts here, undisclosed and non-disclosure. Hope you're with me. So as far as undisclosed income is concerned and undisclosed asset is concerned, there is again a difference. If you do not disclose that income, it becomes an undisclosed income and non-disclosure of income. So if an income, the dividend income which we are taking in the example, if it is not being reported in the income tax returns, by virtue of non-reporting of this income, it will give rise to two situations, two different obligations. One, it will become an undisclosed income, and two, it also becomes a non-disclosed income. When it comes to undisclosed asset, if you are able to satisfy the AO with the source of investment, it stops being an undisclosed asset, but still continues to become a non-disclosure of foreign assets in your income tax returns. So hope I have made this clear enough. This is undisclosed income and undisclosed asset. So going back to our example, the dividend continues to become an undisclosed income, a non-disclosure of income. But since you are able to explain the source of investment, it comes out of the ambit of undisclosed asset, but still it continues to be a non-disclosure of assets in your income tax returns. So this is what predominantly, these are the three aspects which you have to keep in mind. Who are the persons covered? What is undisclosed income? What is undisclosed asset? You have to stay with me for a few more minutes to understand how it is going to affect a resident individual like you and me and most of our clients. So this is additions made with assessing of it. So there are some carve-outs under the undisclosed income and asset in particular situations. If those are additions made because of various TP adjustments and other adjustments, they said that doesn't fall under the undisclosed income and undisclosed asset category. So this is what I was trying to explain. We will share the PPT once the session is done. So there is a difference between undisclosed and non-disclosure, and each has a different penalties attached to it. We will see it later. And once addition has been made under the Black Money Act, the same addition cannot be made under the Income Tax Act on the same set of facts. This is held in Ashok Kumar Singh by Delhi Tribunal. So once you are being assessed under Black Money Act, the same income cannot be again a subject matter of assessment under the Income Tax Act. These are the few pointers which you have to keep in mind before we proceed further. So why are we stressing so much on the Black Money Act? What happens? Like I said, the dividend income in our example, I didn't disclose it in my IT returns. But a client who has come to our office has said, sir, that has already been subjected to withholding tax at 25% in US. When the dividend was paid, I was withheld tax of 25%, and the balance was only remitted to me. Why should I again disclose it in Income Tax Act? See, as I said, there is non-disclosure of income and undisclosed income. Since you have not disclosed that income in your income tax returns, it becomes undisclosed income. Ideally, what you should have done is you should have disclosed that dividend income in your income tax returns, pay tax at your applicable rate, claim foreign tax credit which was withheld by them at 25%, and then pay the balance tax, and then you are compliant with DMA and the Income Tax Act. Since you have not done this, then there is a possibility that an assessment will be done under the Black Money Act. Once an assessment is done under Black Money Act, then the tax rate would be 30% flat 30% rate. They will not give you any deductions. You cannot take your plea that foreign tax credit should be given because the act is very clear. There will be no sort of deductions or foreign tax credits, whatever, when they're doing an assessment under Black Money Act. So that is what no deduction in respect of any expenditure or allowance or set off of any lash shall be allowed to the assessees, whether or not it is allowable in accordance with the provisions of ITA. And unlike Income Tax Act, there is no time limit under the Black Money Act. They can virtually go from 2016 to 2023. There is no limit. Maybe they can come after 5 years and start digging your 2016, 17, 18 returns. Why I'm saying 2016? Because the act was enforced from 2016. So there is no time limit. So you have to be very careful. So what we suggest our clients when it comes to this particular Black Money Act, though as I said in my opening remarks, it doesn't directly deal with resident individuals who are earning money and paying tax. There are stringent penalties under the Black Money Act, which we will be going to see in few minutes. So you have to have a very conservative approach when you get into this particular disclosure requirement. So if you have a doubt whether I should disclose this or I shouldn't disclose this, my suggestion would be disclose it. Next. So this is where an interesting aspect which comes into play. The penalties. There are like in the case of example, I've taken the dividend. In addition to tax of 30%, there is a penalty of 300%. That is 3 times the tax involved. So you earn 100 rupees, you pay 120 rupees, including tax, apart from the interest. Ideally, you're paying 145 because already 25 is withheld while they're making you dividend. So you get 100 rupees dividend after deduction of 25 rupees tax, 25 rupees as tax. Then you are paying here 30% and 3 times of the penalty. This is okay. This I can understand. Now comes the penalty for non-filing of return of income. This is the harsh section under the BMA. The penalties under BMA are multifold. We are concerned in this session with mainly with 42 and 43. 42 deals with section 42 of BMA deals with penalty when you do not file return of income. You have foreign assets, you have foreign sourced income, but you're not filing return of income, declaring them. That's non-disclosure, non-filing of return. If you are not filing return of income, there is a stringent penalty of 10 lakhs. You may have one share yielding dividend of 10 rupees, $10, but still you're supposed to pay a penalty of 10 lakhs because you're not filed your return disclosing that particular share. Section 43 deals with the situation where I have filed return, but I have not disclosed the asset or the income. Like in the case of the resident individual who has obtained foreign holding company shares. Like I'm an employee of Microsoft India, I got shares of Microsoft Inc. based on my ESOP plan. And now I was not aware that I should disclose the shareholding in my income tax returns. So I have not disclosed that foreign assets, Microsoft Inc. shares. So non-disclosure of foreign assets will also attract a penalty of 10 lakhs. Apart from this, huge penalties of 10 lakhs, there is also prosecution which is involved. Similar to 42-43, the defaults what are covered under 42-43, there is also a prosecution which is also there in terms of 51. So the period of prosecution ranges from 3 years to 10 years. An important difference between the penalties and prosecution. In prosecution, you can explain to the officer that there is no willful attempt to evade any tax. Prosecution may be denied, may be kept aside if the AO feels there is a genuine mistake. But when it comes to penalty, there is no mens rea. There is no proof that there is no necessity for the AO to consider that it was a genuine mistake, and thereby he need not put a penalty. So this is one significant difference between penalties and the prosecutions. But luckily, in our favor, there are few judgments which held the penalties which are there in the BMA are directory and not mandatory. Next slide. So this is what, whether it is must or may. This is a judgment of Mumbai Tribunal in Leena Gandhi Tiwari. In this particular judgment, the facts are that Leena Gandhi Tiwari was a signatory to a bank account which was opened by their family members without her knowledge. Only after demise of those family members, she came to know that there is a bank account which was opened and she was made a signatory to that. So in that particular circumstances, the FAI unit or the income tax authorities tried to put a penalty under 42 or 43. The tribunal said, quote, the well-intended harsh laws meant for checking the economic offenders stashing their ill-gotten monies abroad must not be invoked for punishing a venial breach of the law by a bona fide business person. The bona fide actions of the taxpayers must therefore be excluded from the application of provisions of such stringent legislation as BMA. Maybe this is the judgment which we have to use before all the authorities saying that whatever penalties they're trying to put under 42 or 43, these are all nothing to do with our intention to evade payment of tax. It's clear ignorance of law. We all know that ignorance of law is not an excuse. But when there is a simple penalty of 5,000 rupees for not filing a return under Income Tax Act, you bring me under this BMA and put 10 lakhs penalty for not disclosing a single share which I got, or 10 shares or an insignificant shares which I've got because of my employment or various reasons. That is not which is the intent of the BMA. One should argue in that way. And the sections 42 and 43 are luckily worded using may. So we can press the officers asking them to exercise their discretionary powers and not to put any penalties under 42 and 43. And as I was telling, there is an insider information where they said 2,000 notices have been already issued. So I was also speaking with a couple of officers who were also experiencing huge employee crowd coming to their offices and asking them, how can you put a penalty of that much amount under BMA? I was never aware that I am subject of BMA, that I have to read BMA Act and all that. This is not something clear. There is no enough material from the CBTT or government asking every individual to file a return disclosing all these assets. Yeah, there is Schedule FA in the income tax returns, but there is also enough confusion whether a resident individual should disclose it or is it for some intermediaries like the bankers and all that. So in amidst all this, I think the approach should be lenient as far as genuine and bona fide taxpayers are concerned. But that is a call which has to be taken by the authorities. So our plea before the authorities is also to consider these things and do not paint all the people with the same brush, because these are all employees who work hard to earn food for their family. So you cannot put them with stringent penalties. So this is another judgment, K. Mohammed Harris. When the assets were already disclosed in the revised return under 139.5, it cannot be said that there is any willful non-disclosure by the accused. When there is mens rea on the part of accused, then the question of rebutting the presumption under 54 of the Black Money Act does not arise. So these are a few judgments, and the law is evolving, because even though the act has come effect from 2016, very recently only notices have been issued because of the full-blown effect of automatic exchange of information. So because of various countries now becoming signatories of this AEOI, and there's a lot of information flowing to the income tax authorities, they started issuing notices. We have to see how the law evolves, and we have to be very optimistic that they will not put any penalties when it comes to genuine and bona fide cases. So this is just a refresher if someone has missed something while we were chatting. So we thought to summarize the entire thing in a simple table. So when it comes, we want to do a comparison between Income Tax Act and BMA. So jurisdiction, as far as Income Tax Act is concerned, it's applicable to foreign undisclosed income and assets before the enactment of BMA. And from 1715, though the act was made effective from 1416, there was a declaration scheme and window. So from 1715, BMA takes over and all the foreign undisclosed income and assets will come under BMA. Time limit for issue of notice. So we all know that there is 148 Section 90 Act, which has 3 years and in certain cases 10 years as a time limit. As we discussed a bit.
Harsha, we lost your voice. Harsha, I think you are muted.
Harsha sir, your voice is not coming.
Just a minute. Just a minute. Am I audible?
Yes, yes. No, no, voice is not coming.
Rendra, you are audible, but not Harsha.
Okay. The volume of the sound, if you can check.
So Narendra, you can start. Or yeah, Harsha is there. Harsha, you are not audible. Yeah, it's not audible.
Am I audible, sir?
Yeah.
No, it's audible.
Just a minute, sir. He will connect.
Can you hear me now?
Yes, audible.
Yes.
Okay.
And the PPT on the screen is not.
Yeah, I will do that. I just hijacked Narendra's system. Okay. So, as I was saying, there is no time limit for issuance of notice under Black Money Act. But once a notice is issued, there is a time limit to complete the assessment within 2 years. I think that is the reason they are a bit worried to give a notice. They're just issuing some letters asking information and all that. So that is one concern. Maybe they're also looking some guidance from CBDT or central government to proceed for genuine bona fide instances. And the rate of tax, we all know, and the Income Tax Act, it completely goes with the slab rates and different type of persons. But when it comes to BMA, it's flat 30%. And as we discussed a little while ago, there is no deductions under the Black Money Act. Even foreign tax credit, which you would have claimed in other way when you file an income tax under Income Tax Act, that is also not available under BMA. So overall, the position under the BMA is very stringent. It's there from 2016, but it was not looked in that perspective by majority of the people. We were we were advising many of our clients to disclose the dividend incomes and all minute incomes in the income tax returns. But you know how the people generally tend to react when we ask to disclose what is more than necessary. Though we used to say 42, 43 is stringent, they used to put a claim saying that how can they ask us to disclose all the assets when I am using a tax-paid money in India. So these arguments are all for courts, and we have to see how the courts will start interpreting the law. And penalties also, we just put a table. This is self-explanatory, and we will be sharing the PPT with you. As I said, the penalties under BMA are very stringent. So even you have a minuscule amount of income which you are receiving from outside India, but you have not disclosed it, or you have not offered to tax, or you have a small asset which you have not disclosed, the penalty is huge, 10 lakhs. And there is no clarity whether that is 10 lakhs per offense or 10 lakhs per assessment year. How they will start interpreting that is yet to be seen. And again, there is a penalty under Income Tax Act for not filing return is 5,000, but when it comes to BMA, 10 lakhs. So I will be saying, how can you put two penalties for a same offense? But all these questions which we are arising in this particular session, we have to wait for the courts to answer. As of now, the authorities are very clear. If you do not disclose your particular assets in Schedule FA, that's it. You have to pay a penalty of 10 lakhs. That was the attitude. And here, when it comes to the case study which I was referring, the ESOPs and all that, there is a disclosure in the returns, but not under the Schedule FA. Because the Indian company, when they grant me, when they give me salary, they withhold tax at 30% under perquisites and pay the balance amount. So in a way, I can argue that there is a disclosure in the income tax returns. And if my total income is more than 50 lakhs, then I have to file a statement of assets and liabilities. In that assets statement, I will be showing that I am holding Microsoft Inc. shares. Maybe not a clear description, but I would be invariably saying that I'm holding foreign assets. But what I was not doing is to put it under the right schedule FA. So in these cases where there is disclosure in one way or the other, and considering the dominant intention of the BMA is disclosure, just because I do not put under Schedule FA, will it amounts to a big crime, and thus it would attract a penalty of 10 lakhs is yet to be seen. I went on an argument with an officer recently, but she was very clear that as long as you don't put under FA, it's an offense under the BMA. So that is the stand of the department as of now. As I said, we have to see how the law evolves, and we have to take appropriate care. So this is what I wanted to discuss when it comes to the BMA. What is the scope? How are residents covered? How is a resident who is a salary employee and by virtue of his employment gets some foreign shares, and if he fails to disclose that, what are the consequences in the BMA? Now that we understand that there is huge activity from the income tax department when it comes to this foreign assets, so we understand it is advisable that you put all the foreign assets in appropriate columns or schedules in the income tax return. So my colleague Narendra will be sharing the disclosure aspects which you have to keep in mind when you file Schedule FA in ITR. And after his session, then we'll be open for Q&As. I'm handing over it to Narendra.
Thank you, sir, for your detailed discussion on Black Money Act. In this part, we will going to discuss disclosure requirement in the Schedule FA while filing the income tax return in India. So before going to the discussion part, so we need to discuss two more aspects. So one is the doubt that arises to the taxpayer or to the employee is, So how can the government of India gets the information from the outside India? What will happen if I don't disclose in the income tax return? If the asset is located in India, then it is easy to locate it by the government. But when it comes to the asset or income sourced outside India, so how they will get the information? So in this regard, we need to understand there are two agreements. One is FATCA, which is nothing but Foreign Account Tax Compliance Act by the US government. It is the domestic law of the US government, under which the government of US has entered into various agreements with each country. Like India has entered into agreement with USA in July 2015 for sharing of information, which is an automatic exchange of information between the US and India. So similarly, OECD countries have also developed one reporting standard, which is nothing but common reporting standard. And more than 100 countries agreed for that. As of now, more than 90 countries are sharing information to the government of India under automating exchange route. It is not like, government of India is asking the information for specific person and they are sharing. But rather than whenever they get the information, they will share the information to the government of India on a real-time basis. So based on that information, government of India will check the Schedule FE in the ITR schedule. If there is any mismatch, they will issue notice under the Black Money Act. So with this introduction, we'll start the disclosure requirement. This part has been designed in a question and answer mode. So we'll start.
Can I ask you a question now? Is it anything different between US citizens and Indian citizens who are living here on OCI?
Sir, under the Black Money Act, there is no difference between the Indian citizen or any other person. The only requirement to comply with the Black Money Act, if you are a resident in India, ordinary resident, this act is applicable to each and every person who is a resident in India, whether you are a citizen or not citizen of India, or if you are NRI or OCI or PIO or any person, even if you are a citizen of USA or if you are a foreign national, this act is applicable, provided you are a resident in India and ordinary resident.
So if you are living in India and filing taxes in India and you go to like US or something and you make some money on salary there, and you still have to disclose in your Indian IT return?
Yes, sir, that we will discuss. There is a specific question for that. We will discuss that also. So what are the disclosure requirements by the foreign nationals and non-resident and overseas?
Okay.
So who is required to file return in India? So normally under section 139(1) of the Income Tax Act, it says that every person, every company, firm is required to file return of income. If in the case of individual and UHF, if the amount of income earned in India or by the resident in India exceeds the maximum amount which is not chargeable to tax, that is 2,50,000 rupees. If your income exceeds 2.5 lakhs per year before claiming any deductions, so that person is required to file return of income in India. So, but however, there is a proviso to the 139(1) fourth proviso, which says that even you are not required to file return of income in India by virtue of your income earned. So, if you are holding any asset, including a beneficial ownership, any asset located outside India, or if you are having any income from that asset, you are required to file return of income in India. So the second question is, which ITR is required to be filed? Generally, salaried employees or normal business people will file ITR 1, Sahaj, or ITR 4. So it is a simple form, 1-page ITR form or 2-page ITR form. They will fill the total basic salary, total salary, and they claim ETC deductions and submit the return. But if that person is holding any asset outside India or any income from a source outside India, such person is not eligible to file ITR 1 or ITR 4. So such person is required to file ITR 2 in India and submit the Schedule FA, which is annexed to the ITR 2.
So whenever you are filing that salaried employee is filing income tax return in India, you should make sure that he is filing ITR 2 instead of ITR 1 or 4. So whether foreign national is required to file Schedule FA. So as discussed earlier, under the Black Money Act, every resident individual is covered. So however, there is some exception given to foreign national for filing the Schedule FA. So it says that if you are a foreign citizen, which means you are not being a citizen of India, who has come to India on a business or employment or student visa. So you have to come to India on any of the three scenarios. One is business purpose, another was employment, or you are a student in India. Student comes to India and acquired during any previous year, in which is a non-resident, which means that when you acquired any property as a non-resident outside India, but you come to India, you become resident by virtue of provisions of Section 6 of the Income Tax Act, and the purpose of the visit is business, employment, or student, then you are not required to submit Schedule FA unless you have earned any income during that year from any specified asset which is located outside India, which means that an NRI or any citizen outside India has come to India and has become resident in India for a business or employment student and received any income from any asset located outside India, that asset needs to be reported in India, and income earned from that asset has to be submitted in Schedule FA. So other citizens, if you are not satisfying any of the conditions specified in this class, which means you have come to India for any other purposes other than business, employment, or student visa, and you become resident in India by virtue of Section 6, and you are not an RNOR, which means you became resident and ordinary resident. So you have to file return of income India and submit Schedule FA, which means that even if you earned that asset when you are non-resident or from a source outside India, those assets also should be reported in Schedule FA.
Sir, I have a quick question on that. Who is in India on a business, employment, or student visa?
Yes, sir.
Suppose if a US citizen, I'm telling because most of the people are US citizens. So US citizen comes to India and living here for a while, let's say 8 months in a year.
Yes, sir.
And still he claims that he is in India in a business.
Yes, sir.
How do you distinguish, how do the government distinguishes that he is in business or not?
At the time of issue of visa, they will issue visa for purpose of business or employment or tourist visa.
If the person is holding an OCI card, there is no issuing of.
Then that the burden of the proof on the SSC, sir. They has to prove to the department that he has come to India on business purpose. And
yeah, got it. And second question is, see, let's say if I earn money in the US, first, usually if you're filing a joint return, the first $25,000 is exempt from any income tax. And if you're also filing an income tax return in India, and is that $25,000 which you got exemption in the United States, is it added to your Indian income?
So computation of income under the income tax provisions are entirely different from disclosure requirements under Schedule FA. That is the first thing which we should remember. So Schedule FA only for the disclosure purpose, sir. Once you disclose any income or asset in Schedule FA, doesn't mean that income or asset is liable to tax in India. It is only for the disclosure. Okay. So your answer to your question whether that exemption will claim while computing the return of income in India. So under the income tax provisions, computation mechanism is entirely different. So you have to include all total income that you have earned from outside India and the income earned in India in the income tax return, and you will get the only basic exemption limit if you're an individual, any deductions under ATC or any other exemption under Section 54 or Section 10. That is the only option available. So just because we are getting any deduction or exemption under US, you will not get that exemption here. So only thing we can avail is if you have paid any tax outside India while filing return of income in US, that tax can be claimed here as a foreign tax credit by filing Form 67 in India. That is the route available. But a disclosure requirement under Schedule F is entirely different from income tax payable in India, sir.
Okay. So we are discussing here only about the disclosure issue.
Disclosure requirements. Just because you disclose some amount that you have received in outside India,
Okay.
it doesn't mean that that amount is liable to tax in India.
Okay. Thank you.
So next question is whether the reporting on financial year basis or a calendar basis. This question arises because if you see the Income Tax Act or Black Money Act, it says that if any person being a resident in India holds any asset or income outside India, he has to submit that Schedule FA while filing the ITR. However, if once look at the Schedule FA in the ITR form, it says that if any person holds any asset during the calendar year ending 31st December, he should report that asset for that calendar year. The purpose of the purpose of the requirement to file on calendar year basis is, as discussed earlier, so there is an international agreement between various countries where they will share the information on calendar year basis. So whenever government of India receives information from USA, for example, they will match the information that you have submitted in the income tax return. So in order to match that information, so income tax form says that we have to submit Schedule FA on a calendar year basis. So there will be a mismatch between the income reported in the income tax return for the purpose of paying the income tax and for the purpose of Schedule FA. So under the provisions of income tax, income is accessible to tax on financial year basis. However, Schedule FA is required to be filed on a calendar basis. So what needs to be disclosed in Schedule FA? What is this Schedule FA and what are the assets to be disclosed in Schedule FA? Then we will discuss this. Schedule FA can be divided into 4 parts generally. Schedule FA contains tables, table A, B, C, D, E, F, and Z. Table A contains 4 subtables, table A1, A2, A3, and A4. So these are the 4 types of assets that needs to be disclosed in schedule. Table A. Table A1. Table 1 A1 states that if you are a resident in India and holding any foreign depository accounts at any time during the calendar year, as on 31st December, we need to report that depository accounts in Schedule FA. So depository accounts are nothing but our bank account, fixed deposit, saving deposit accounts outside India. Then we need to disclose following details. What is the status of the account? Whether you are holding that account as a beneficiary owner, or you are the legal owner, or you are the beneficiary of the asset. So we need to give the opening date of the account. When did you open that account? So what is the peak balance during the calendar year in that account? What is the closing balance in that depository account as in the December 31st? Also, if you have received any interest from that account for the calendar year on 31st December, we need to report. So here we'll get the mismatch between the income tax return and the Schedule FA. In the income tax return, if you receive any interest for the financial year, we'll include that interest in the income tax return and pay the tax. Whereas while filing the Schedule FA, we need to report interest received during the calendar year against the financial year. The next one is table A2. These details of foreign custodial accounts held at any time during the calendar year as on 31st December. The first table discusses with the deposits, bank account deposits. The second one is custodial deposits, similar to our demat accounts. So in this table also, we need to give the status of the account opening date, peak balance, closing balance, and if you receive any interest or dividend or sale proceeds from the custodial accounts, then we need to report those details. Table A3 deals with foreign equity and debt interest held at any time during the calendar year as on 31st December. Under this table, we need to report any equity or debt held by the individual or any resident in India in a country outside India. We need to report date of acquisition of acquiring the interest, initial value of the investment, peak balance, closing balance, and gross interest or dividend or proceedings from any sale or redemption during the period. So these details we need to give on calendar year basis. Table A4 deals with the insurance contract. If a person resident in India holds any insurance with a foreign country, such person is required to disclose those insurance contracts. The date of the contract, the cash value or surrender value of the contract, total gross amount paid during the year, if any, you need to report. Here, till now, we discussed table A2, table A4. So, till table B deals with the any financial interest in any entity held at any time during the calendar year as on 31st December. Financial interest. If a person acquires any equity shares in a company outside India, those shares may be disclosed in table B. The reason behind this is you may report those shares in table A2 as well, because table A2 deals with the custodial account. If you are holding any shares outside India under a custodial account, the underlying asset is nothing but equity shares. That share may be disclosed in the schedule, table A2, or if you want to disclose that detailed shares, each shares wise details, then you can submit from table B in schedule FA. So details of foreign interest in any entity held at any time during the calendar year as on 31st December, we need to report. So nature of interest, date since held, total investment in that account, income accrued from such account, and nature of income. The difference between table A and table B or C other tables are, in table A, we need to report details of income or details of assets for the calendar year as on 31st December. However, for table B, in addition to the above details, the SSC is also required to submit how much income is included in the income tax return for the financial year. So it contains additional columns. In addition to the details for the calendar year, the SSC is required to submit if you receive any interest income or any dividend income, any capital gains from this source outside India or any asset located outside India, we need to report how much income is included in the total income. So income tax would offered in the income tax return. So the difference between the first one, second one is, in the first scenario, we will disclose foreign assets and income on a calendar year basis. For the last column of the table B, we report income on a financial year basis. So next we'll discuss table C. Table C deals with the immovable property. Similar to equity shares or other financial interest, table C deals with immovable property held by the residents in India at any time during the calendar year as on 31st December. So date of acquisition, total investment cost, income derived from the property, nature of income, and additional column for the disclosure for the any income taxable and offered in the income tax return during the financial year. So table T deals with any other capital asset, any other miscellaneous capital asset, any other capital asset which is not covered from table A to table C. Those assets needs to be disclosed in table D of schedule FA. So table E is a special table which deals with assigning authority. Even we don't have any asset located outside India, but just having a signing authority. For example, there is a company in India and which has a subsidiary in outside India, or Mr. X has incorporated a company outside India for which there is a bank account in our foreign country. That bank account has authorized, there is an authorized signatory in India. Such person is to report the details of the account held outside India in table E. name of the account holder, account number, peak balance. If you have received any income from that account, that income is to be reported in table E. Table F deals with trust. If a resident person creates any trust outside India, or that person is a beneficiary, or that person is a settler, those details are required to be submitted in table F. Even if the person doesn't have any asset outside India, but only earning income from outside India. For example, such person is earning salary income or income from dividend, or sorry, income from dividend is not covered, salary income or any business income or any profession income, which that person is earning from a source outside India without holding any asset. Those details are required to be disclosed in table G. Table G deals with details of any other income from a source outside India, which is not disclosed above, and income from business or profession. Name and address of the person from whom that income is derived, income derived, nature of income, whether income is taxable in the year in which that income is received in the hands of the resident. So these are the full tables under Schedule FA, which needs to be submitted by the resident in India. So one more aspect which need to be remembered is, as discussed, that Schedule FA is to be submitted on calendar basis. For example, a person in India acquired an asset outside India in the month of January 2023. So that out arises for the filing return of income for the assessment year 23-24. Whether that income is reported to be in India, the answer is no, because the table says that a resident individual is required to submit Schedule FA for the calendar year 31st December 2022, whereas the person acquired the asset in January 2023. Though that income, if any, earned from that asset during the January or February, March 2023, though that income is taxable in India for the assessment year 2023-24, but for the purpose of filing Schedule FA, we need to report those assets which are held for the calendar year as on 31st December. So let us discuss some more questions. Whether a deemed resident under Section 6(1)(a) is required to file Schedule FA. Deemed resident is a concept inserted into the Income Tax Act, which says that if even though person is not a resident in India, by virtue of provisions contained in Section 6(1)(a), he will become resident in India. However, the Blackman Act says that the act is applicable to only residents and resident and ordinary resident, whereas deemed resident will be considered as R1, RN, or for the purpose of Income Tax Act. Such person is not required to file Schedule FA. When a person acquires asset while he was a non-resident, whether such person is required to make any disclosure. So there is a person, Mr. X, is residing outside India from last 15 years. While he was a resident, outside India, he's acquired some immovable property, some shares, some assets outside India. However, after 15 years, he has come to India and he has become resident and ordinary resident in India. In that case, though such person earned that income or assets when he was a resident, non-resident in India, such person is required to submit Schedule FA, because it says that any resident in India holds any interest or any asset located outside India, whether that income is earned during the year, whether that asset is acquired during the year or previous year, that assets is required to be reported in Schedule FA. Whether a resident is required to report those assets every year or only in the year acquisition. So, as discussed, this asset is required to be reported on yearly basis, not in the year of acquisition. So, if any person doesn't disclose any asset for a particular year, there may be a chance that department may issue notice and levy penalty under Black Money Act 10 lakh rupees. So what is the time limit to issue notice under Black Money Act to assess foreign undisclosed income? So as discussed earlier, there is no time limit under the Black Money Act to issue the notice. So as long as the income tax department gets the information from a source from a country outside India, they will issue notice. Once they issue notice under Black Money Act, they will compute the income and they will assess to tax at the rate of 30%. Can a person file a revised return or update return to comply with the above requirements? So now we are discussing that every resident in India has to file ITR 2 and submit Schedule FA. So by the time we are discussing these requirements, many of the employees or residents might have filed income tax return in India. So the question arises whether he can file revised return or updated return to comply with the reporting requirements under Schedule FA. So normally under the Income Tax Act, a person can file a revised return or belated return on or before 31st December, the relevant assessment year. So if any of us doesn't file Schedule FA, so we can file Schedule FA now for the assessment year 23-24. So what will happen before assessment years? So for that, SSC can file update return for last 2 years. So there is a time limit for filing update return, which is a new concept under Section 139 ATA. Under Section 139 ATA, a person in India can file update return subject to paying of additional income tax. So if you are a person resident in India and holds any asset located outside India, if you are not filed return of income or not disclosed return of schedule FA in the return of income, so such person can file updated return and disclose those assets. There is an exception to filing a updated return, which interly includes where any proceedings under the income tax are pending or completed for the assessment year, or if income tax department receives any information from any country outside India, say for example from US, and that information has been shared to the SSC. So in that case, SSC in India cannot file update return. So automatically they will issue notice under Black Money Act. So they will proceed to file assess the tax under the Black Money Act at the rate of 30% plus 300% of the penalty. So what is the disclosure? What is meant by disclosure in Schedule FA? So if an employee receives any ESOPs, as discussed by Mr. Asha sir, so if there is an employee who has received any ESOPs from a company outside India, and those income or dividend income or salary income is included in income tax return, but however that share is not disclosed in Schedule FA, whether that can be considered as a non-disclosure for the purpose of Black Money Act. The department is under the view that unless you fill that Schedule FA, even that assets are included in Schedule AL, there is another schedule called Schedule Assets Liabilities, which is required to be submitted if your total income exceeds 50 lakhs. So even that asset is included in Schedule AL, but is not disclosed in Schedule FA, the Black Money Act will come into play and penalty of 10 lakh rupees will be levied. That is the stand taken by the department. So it is better to the SSC to submit each and every asset that is held outside India in Schedule FA. So this one is a case study, the last one, which is discussed by the Arsha sir. So there is a ABC Inc., which is located outside India, USA, and which has subsidiary in India, ABC Private Limited, and employees of ABC Private Limited are receiving ESOPs from the ABC Inc. USA. So what are the consequences under the Income Tax Act and what are the consequences under the Black Money Act? So these consequences have been divided into 3 parts. The first part is at the time of receiving the shares. The second part is at the time of receiving the dividend income. And the third one is at the time of disinvestment of that shares, that is selling of that shares. So we'll discuss first consequences under the Income Tax Act at the time of issue of shares. So Income Tax Act says that if any employee receives any perquisites by way of ESOPs or sweat equity shares, that income is treated as salaried income in the hands of the employees in India and subject to tax as a salary income. For the purpose of computation of income in India, fair market value as in the date of exercising the option shall be considered as salary. Once the salary is determined, the company in India, ABC Private Limited, will deduct the tax under Section 192 and remit the same to the government and issues the Form 16 to the employee. While filing the form return of income, the employee simply submit Form 16 in ITR 1 and submitting the return of income. However, as discussed earlier, we need to report Schedule FA also because that person is holding shares in a company which is located outside India. So if you don't report it, don't disclose those assets in Schedule FA, though that income is included in the return of income. So Black Money Act will come into play and the penalty will be levied for the non-disclosure of Schedule FA. So these are the consequences under the Black Money Act at the time of receipt of shares. The second one is receipt of dividend income. So when employee receives any dividend income from a shares or ESOPs which are located outside India, that dividend income is taxable in India under the provisions of Income Tax Act. So SSC required to include that dividend income in the return of income and claim foreign tax credit by filing Form 67. Otherwise, the same amount will be considered as undisclosed income under the Black Money Act, and the tax at the rate of 30% will be levied without providing any credit. So the third part is at the time of selling those shares, which means the SSC, after receiving the shares from a foreign country, transfer those shares to a person resident outside India or any person. That income, any gain arising from that sale is to be reported in India. So if there is any sale at the rate of 100 rupees, for example, whereas the ESOP has been issued at the rate of 50 rupees, the balance of 50 rupees has to be included in the income tax return and pay the tax here. So interestingly, there is a buzz in the market regarding the ESOPs, which is nothing but ESOPs are RSU. There is no much of difference between ESOPs and RSU. The only difference between ESOPs and RSU is in the case of ESOP, there is a option, there is a concept of exercising by the employee, whereas in the case of RSU, the shares will be automatically vested with the employee after the vesting period. Whereas in the case of ESOPs, only when the employee exercises the option, those shares will be vested with the employee. So for the purpose of deducting the tax, so when there is an ESOPs given by the foreign company to the employees of the Indian company is under the obligation to deduct tax at the rate of 30% under Section 192. So what they are doing is, the foreign company, instead of deducting the tax from the employee's salary, they're selling 30% of the shares given to the employees. So for example, 200 shares have been allotted to the employees during the current year. So 200 shares have been vested during the year. Out of 200 shares, 60 shares are being sold by the parent company immediately when the shares are vested. So employees are receiving balance 140 shares into their demat account located outside India, and they're reporting only salary income from 200 shares as ESOP, and they're reporting in Schedule FA that they have received 140 shares. Whereas the concept is they have received 200 shares into their demat account, and the parent company, on behalf of the employees, they're selling 60 shares. So those 60 shares has to be reported as income from capital gains. There may be gain or there may be loss, there may be nil gain. So even then, that person has to report that transaction also. The transaction of selling the shares at the time of issue of ESOPs for the purpose of deducting the tax by the parent company. So once the parent company sells 30% of the shares issued to the employees, the 30% amount is being remitted to ABC India Private Limited. So ABC India Private Limited is remitting the amount to the Income Tax Department and issuing the Form 16. So there is a tricky issue here. So at the time of issue of ESOPs also, there is a greater chance of getting capital gains. So their SSCs are failing to recognize that there is a capital gains and failing to report that income or loss or nil in income tax return and Schedule FA. So this needs to be remembered while filing the Form 16, filing the income tax return and receiving the ESOPs. So this is the case we need to discuss. We thought we discussed at the because so many people are receiving ESOPs from US companies that they don't aware of the this tax mechanism in India and USA. They're failing to report those assets or those income or dividend income or capital gains in India. So this needs to be taken care while filing the returns in India. So I think so we finish. If you have any queries or any questions, so we can discuss.
Yeah, sure. Thank you so much. Thank you, Mr. Harsha and Mr. Narendra, for a very detailed presentation and so much of information. I request members and guests to post their questions in the chat box, please.
Narendra, there is one question in the chat box. Can you take that? Can you please repeat the last example of sale of shares by US company again? 30%.
Narendra, you can stop sharing the screen, please. Yeah, thank you. The questions in the chat box.
There's one question. Can you hear me?
Yes, sir.
There's one question, Narendra. Can you please repeat the last example of
Can you
share
please
of
repeat
shares
the
by-
last example of shares by US company again? 30% sale example. Yes, sure. I will. Let's take an example. Mr. X is an IT employee working with a global corporate. Mr. X has been granted stocks of a parent company located outside India under the employee stock reward scheme. Total stocks granted are 1,000. For example, Mr. X, being an employee of IT Giant, has been received total stocks of 1,000 units. Out of 1,000 units, 200 units are vested during the year. So SSC has received 200 units into his demat account. Fair market value of the asset as on the vesting date is $100,000. So 200 into 1,000, 2 lakhs rupees is $2 lakhs is the total salary received by the employee for that year. So in order to comply with the TDS requirements under section 192, so instead of collecting 2 lakhs into 30%, that is 60,000 from the employee, what parent company is doing is they are giving instruction to the custodial accounts, those who are maintaining that shares account, whether it is Morgan Stanley or E-Trade or other share brokers. So the instruction is, instead of collecting the amount from the employee of 30%, you sell off 30% shares issued to the employee. So for example, $200 shares have been issued to the employee. So to comply with the TDS requirements, they're selling $60,000 equivalent shares to comply with the TDS requirements. So once they're selling that $60,000 of stocks, then they are sending that amount to the subsidiary company. So subsidiary company paying that 30% to the government of India to comply with section 192. Here the point that needs to be remembered is they are issuing shares on day one, but they're deducting the TDS or selling the shares 30% on day two, or they're selling the shares on subsequent period, which means in day one, the share price may be $1,000. On day two, the share may go up to 1,100 or come down to 900. So in that case, in order to meet $60,000 of TDS amount, they're selling equal amount of shares. So there is a chance that capital gain may arise or capital loss may arise, or no loss, no gain may arise. So employees in India are in the impression that they receive $2 lakhs of shares. So a company is deducting the TDS, they're issuing the Form 16. So I am filing the return of income. There is no additional requirement to disclose any other asset or any other income. Whereas there is a underlying capital gains here because they are selling 30% of the shares on behalf of you and recovering that amount for the TDS amount. Though they are selling shares on behalf of you, those shares belong to the employee. So which means that employee is earning capital gain or capital loss. So that amount needs to be disclosed in the income tax return.
Okay, thank you. I request
One more please.
members, if there is any question, they can unmute themselves and they can ask. If there is any question, please.
Yeah, Narendra, there is, you mentioned about ESOP and RSU. Is there any difference in tax treatment as far as ESOP and RSU is concerned?
There is no difference between ESOPs and RSU for the tax treatment, sir. So only difference is in the case of ESOP, employees specifically exercise the option. If the employee doesn't exercise any option, those shares will not be transferred to the demat account of the employee. Whereas in the case of RSU, once you comply with the vesting conditions, those shares will be transferred to your demat account. That is the only difference. So once you receive that amount into your demat account or your shares account, that income is liable to tax in India if you are a resident in India, either under ESOPs or RSU.
Yeah, thanks, Narendra.
Yeah.
There's a question that is there any exemptions under BMA?
Let me go.
There's one
There
exemption for bank accounts where peak balance does not exceed 5 lakhs. You are exempted from disclosure requirement.
So under the Black Money Act, they says that you need to disclose each and every asset located outside India. So there may be instances where a person may go outside India for as a student or business purposes, come back to India and forget to close account located outside India. So there is an exemption for levying of penalty if the amount laying in the bank account is not more than 5 lakh. That exemption is applicable to only bank account, not to other assets. If you don't disclose any other asset, even that asset is equivalent to 1 rupee or 10 rupees, they levy penalty. Only for the bank account, the amount is not more than 5 lakh rupees, they don't levy penalty.
Okay, thank you. Is there any more questions, please? If you have question, you can unmute and ask, please.
Hi, Narendra, this is Shiva here.
Hi, Shiva. Yes.
Yeah, Narendra, what about the place of effective management if a foreign national sitting in India and managing foreign companies? So whether they covered under this disclosure of Schedule FA?
Sir, determining place of effective management is not an easy task. Till now, there is no such scenarios in foreign company becoming a resident in India.
No. Foreign national resident in India.
There is no, if we're an individual person, there is no concept of place of poem or place of management.
Okay.
So for the purpose of individual
companies.
For the purpose of individual, residential status will be determined based on the number of days stay in India. There is no concept of place of management for in the case of individual. That is applicable to only companies, sir.
Okay. Suppose if foreign national resident in India as per IT Act, Income Tax Act 6 section.
Correct, sir.
And he is managing foreign companies from India and he is not earning any money in India.
So there is a I understand your question, sir. There is a person, Mr. X, resident in India and has invested in a company located outside India. That foreign company is receiving business or dividend or interest income. Right. Whether that income is reported by the individual in India. Right, so that person is not required to be reported, sir. But department may ask because that individual is a beneficial owner of the asset. Okay. Held by the foreign company. So that person needs to be reported. But there is a Jaipur tribunal judgment in the case of Krishnadas Agarwal. It says that foreign company is a separate legal entity. There is no connection between Indian person and foreign assets held by the foreign company because that is a different legal entity. So Indian person is not required to report any such assets in India.
Suppose he is 100% shareholder of that company. Suppose this corporation.
Sorry, your voice is not audible.
Hello.
Yes,
Now
yes.
it's audible.
Yes, sir.
Suppose foreign citizen, resident India.
Okay.
And he is earning money through some company, that is some S corp like that.
Okay.
So can he declare here or he need not?
If that income is taxable in that person hands, what is the nature of income?
Okay. If it is taxable in foreign?
If it is taxable in outside India also, because if you are a resident in India, being a foreign national or a citizen of India, receives any income from outside India, so that a source country will withhold the tax at the rate of at the applicable tax rates under domestic law. Being a resident in India, we need to report total income earned by you, I mean SSE, on a global income basis. So while filing the return of income, you can claim taxes paid outside India if that is available, subject to conditions. We need to file Form 67 and we need to check the relevant DTWA between the India and the other country. If there is any provision for the double taxation avoidance agreement and there is any article deals with particular income, and if their tax is really deducted in that country, we can claim tax in India by filing Form 67, sir.
Only as per income we need to file here, but we need not file for any poem, right? Place of management.
And that is not applicable to individuals, sir. That is applicable to only company.
Okay, thank you.
Any other questions, please? So we'll be sharing the
one more, I think, if an SSE reports under table A2 rather than table B, will the extra reporting of income? So yes, Schedule A2 doesn't contain details of income earned or income reported in income tax return, but whereas Schedule B contains that clause, there is no much of difference for the disclosure purpose. Once you disclose the income in Schedule FA, I mean asset in Schedule FA, whether it is A2 or table B, and included taxable income in income tax return, they may not question, they may not question SSE.
Thank you. I would like to inform that we'll be sharing the presentation which was shared by the speakers. We'll share with you and also the detail of the speakers. So in case if you have any specific question related to your companies and all and you want to directly discuss with them, we'll share the email IDs and you can contact them and send your queries. And also if you have any other detailed questions that you would like to discuss, you can take an appointment and meet them. So in case if you want any help from myself, please let me know. With the whole program, I think we are at the conclusion of the program. I thank Harsha